Now we go to the hard part, making the cuts. Step 3, we start with below the line cuts. So let's talk about what's the difference between below the line and above the line. The traditional financial statement, I'm a CPA. Traditional financial statement my industry has produced forever is an income statement and balance sheet. You typically get that about 15th of the month for the prior month. And what that does is it tells you how much cash you had in the bank 15 days ago, or how much your customers owed you 15 days ago. The income statement, traditional income statement and balance sheet are not designed to take action. They're designed for compliance. They're designed to make sure that the bank is happy. They're designed to make sure that it's easy for the CPA to fill out the tax return. That's the reason why your expenses are listed in alphabetical order. Well, most of our businesses have payroll is the biggest expense. In fact, it's typically with fully loaded payroll is 70% or more of the total expenses. And when payroll just shows up on a couple of lines, 3/4 of the way down that alphabetical list is payroll expenses and payroll taxes and maybe officer's salary, you can't take action based on that number. What we recommend to our clients, all clients, and including nonprofits, is that you separate out the above the line costs from below the line costs. So what's the difference? Well, your typical income statement has income minus expenses equals profit. When you want to do management reports, your income, you separate out your cost of goods sold, which is the direct cost that your customer directly paid for. It's the direct labor that directly earned you the income. It's the direct material, the stuff you had to buy in order to be able to earn that income. All those costs are above the line. And the line is gross profit margin. So your income minus your cost of goods sold, your COGS, is your gross profit. And to me, this is the single most important data point of every business, gross profit as a percent. It's why on Shark Tank, all the sharks will always ask on every deal, how much did that cost fully landed? Why are they asking that? Because they want to know what the margin is, the incremental margin on each unit. And that's management reporting. That's how you convert your accounting system from a financial statement to a management reports. You separate out the labor costs and the materials cost above the line. And what's nice about it in QuickBooks, you change the account type from expense to cost of goods sold account type, and it's retroactive. And then you can see gross profit. Normally, I'm looking at gross profit and coaching clients that you want to look at gross profit to make the biggest decisions in the business. Number one, pricing. You want to look at your gross profit to see how you're pricing your jobs right. You want to make decisions about hiring and firing clients and staff. You want to see what sales and marketing generates the most profit. How do you get the most productivity of your people, and which of your people generate the most profits? You do that by separating out those above the line costs and looking at gross profit. Today, we're talking about above the line versus below the line because you got to make cuts. And so what we suggest is you want to start with your cost cutting by focusing on the below the line cost first. Why? This is your overhead. This is the cost that's not generating you any money. It's the necessary evil. It's the indirect cost, the labor and the overhead that you need just to keep the lights on. It's your IT, HR, accounting, legal, sales, marketing, facilities. It's all the costs that are not direct, not what the customer directly paid for. And what we recommend is you look at those costs first because they're not generating revenue, and you want to save your money for the people for generating your revenue, and do that last. So first, office costs should be slashed right now, right? We're not in the office, that's automatically happened, but evaluate, do you even need the office? Do you need to have the shredding, the supplies, the rent, the cleaning services? Then look at all non-essential company expenses. We typically send 7 people to Scaling New Heights. It's the big Intuit conference every year in June, and we're not going this year. That's $20,000. Look at everything that's not essential, especially on the credit card. You want to audit every line because those recurring costs can add up fast. We found $1,500 just by $49 a month for CPA practice advisor that, was a nice to have, but not essential. And then you want to look at overhead and see what can you outsource. Because what outsourcing does is it converts a fixed cost of people into a variable cost. And when your needs go down, your costs go down. So you're matching the expenses with your revenue, and that helps you manage profits and increase profitability. Typically, you can save 30 to 40% by outsourcing the bookkeeping and the accounting. And what you really need to be looking at is if you don't have 40 hours of HR, IT, or accounting, then how do you use other people's resources to get what's often a better result at a lower cost than doing it yourself? And then if you want to keep that person, because that bookkeeper is a trusted, valuable person, let's find ways to put them into revenue generating opportunities. Help with the proposal. They know all the clients, they know all the service providers, they know all the services you do. Can they help you with biz dev? Can they help you study your processes and streamline things instead of spending a lot of manual efforts doing billing, collections, and bill pay?